Good afternoon, everyone. This is Ed Talisse for Chelsea Global Advisors and the CQF Institute. It is Monday, March 23rd, 2015. A couple things to talk about this week. Firstly, in the middle of last week, the markets were relieved to finally get the Fed meeting out of the way. And at that meeting, we learned two things. That firstly, U.S. Federal Reserve seems very intent on moving out of the extraordinary phase of their monetary policy and start to begin to normalize rates sometime soon. However, we also learned that Ms. Yellen is not immune to understanding that some of the data in the U.S. has been softer than expected, and that the strength of the dollar is very challenging for a number of U.S. companies. So we learned that, yes, they are going to hike rates probably sometime later this year or early next year, but ultimately they are still highly data dependent, and as long as the data is soft, the ultimate rate to which they move over the near term is probably lower than the markets expected before the meeting. So the markets reacted, both the fixed income markets and the equity markets indeed reacted very well. And we're now, particularly on the NASDAQ and again on the S&P and some of the US indices, close to all-time highs. So I think that's out of the way. The second thing that we've talked about for the last couple of weeks is that in order for the market to really behave as it does in most years, is that we need a stable dollar and we need stable oil prices. Now, I think over the last couple of weeks, we've really not gotten either. So I think the near-term outlook here is for continued outsized reactions to both the level of the dollar and the level of energy prices. That brings me on to my next point. We get a lot of questions from clients and investors that are interested in either active strategies where you're looking for security selection and trying to find good names in a fixed income portfolio or attractive names in an equity portfolio versus being more passive and just sort of investing in low-cost indices and large bond funds and such. So in my view, I've always almost always favored, to favor the latter, where my strategies tend to be more index hugging and passive, although I tend to look at security selection strategies as well. I think what is important for investors to think about and remember, as the indices move higher and higher, it gets more and more difficult to continue to see passive strategies outperform the overall market, and security selection strategies may be coming into favor. Now, what I'm going to say, none of it is necessarily original, and there's a lot of academic research on the following points, but there is an environment that seems to be very good for security selection or active strategies, and I think that we are approaching that point right now. So those are as follows. You need the market to be somewhat volatile, and clearly over the last couple of months, the market has seen above average volatility, particularly in U.S. equities. Secondly, you need good dispersion, and by dispersion I mean there needs to be a wide and noticeable difference between returns on individual stocks that make up the indices and the indices themselves. And it also helps is that there is dispersion within sectors of the market. So for example, in today's market, there's fairly high and decent dispersion in the financial sector, where certain banks have shown pretty decent returns over the last 6 months, and other banks have lagged quite a bit. So firstly, you need volatility. Secondly, you need dispersion. Third thing that you need is good liquidity, because if you're going to do selection strategies, you have to be able to move in and out of the market. Now, there's been a lot written on this recently and a lot talked about this, but for now, I think the equity markets continue to offer much, much better liquidity. And if you read a lot in the financial press, a lot of investors are concerned with liquidity in the fixed income markets, particularly credit-intensive financial markets like high yield or even investment grade. The next point that you need is you need a macro environment, and I believe today's macro environment is very suited to this, where there's a large amount of disagreement and discussion about how the macro environment's going to play out over the next couple of months. So there's a camp here in the U.S. that thinks we're on the precipice of renewed slowdown in the economy, and that we may go into a recessionary period pretty soon, where there's another camp that thinks this is really the early part of a multi-year expansion. So I think the fact that there's some disagreement about how the macro environment is going to play out is very good for selection strategies. And lastly, you also need valuations that are somewhat below average, because it doesn't really make all that much sense to pick stocks or single names out if all valuations on average are way above historical norms. And I think in today's market here in the US, certain sectors, and I would mention the energy sector, again maybe the financial sector, where certain valuations are not extremely above historical norms. So to recap, I think we're moving from a period where index passive strategies have worked well for investors to a situation where more active or security selection strategies may be in favor for investors. That's it for this week. Thank you again for watching. Edward Talisse, ChelseaGlobalAdvisors.com, and the CQF Institute. Thank you.